Analysts and investors are all digesting Federal Reserve Chair Powell's two-day testimony in Congress. In his opening remarks, Powell repeated that there is no rush to adjust interest rates. With the new sheriff in town, many questions focused more on how the institutional strength of the Reserve Bank can still be assured. Hello, this is Bode Oshosami on Global Business Insight, where we bring more depth to the main business headlines. CATL, that's the world's largest electric vehicle battery maker, has filed an application for a secondary listing in Hong Kong. The listing of contemporary Amperex Technology Co., a major supplier of Tesla, Volkswagen, and other electric vehicle makers, is expected to be one of the city's largest share offerings since 2021. U.S. January Consumer Price Index, that's CPI, released later today, is a test of whether inflation pressures are easing and will influence the Fed Reserve's decision. We expect to see headline inflation of 2.9%, matching the annual gain seen in December. Consumer prices are expected to have risen 0.3%. That's over the prior month, slightly under the 0.4% monthly increase we saw in December. U.S. markets closed mixed. The Dow Jones Industrial Average edged slightly higher, while the tech-heavy Nasdaq Composite pulled back about 0.4%. European stocks also closed higher despite the turmoil around tariffs. There, however, remains a lingering cautious tone as the market waits for universal like-for-like tariffs, that's reciprocal tariffs, promised to be announced later in the week. Another bellwether stock, the beverage maker, that's Coca-Cola, yesterday reported fourth quarter earnings and revenue that surpassed Wall Street expectations. Q4 earnings of 55 cents a share beat 52 cents expected, while revenue of $11.5 billion topped expectations for $10.7 billion. A strong dollar poses headwinds as CEO James Quincy adds that global scale and local market expertise continue to position Coca-Cola to exploit the vast opportunities it sees ahead. U.S. Vice President J.D. Vance told Europeans yesterday that too much regulations on artificial intelligence strangles innovation, rejecting content moderation as authoritarian censorship. In another sign of divergence on artificial intelligence governance and indeed on many other socioeconomic fronts, the United States and Britain did not sign up to the final statement of the French-hosted AI summit calling for inclusive, open, ethical, and safer AI. In Nigeria, the yields on Nigerian Eurobonds were down to their lowest level in 2025 last week as they continue to attract significant foreign investor interest, driven by improving economic prospects and moderation in yields internationally. Average yields on Nigerian Eurobonds declined to 9.05% on February 5, the lowest in 2025, signaling higher buying interest by investors. This, in my view, is still expensive borrowing, and we need to improve our risk rating to investment grade, and so lower cost of borrowing, especially in the context of higher global interest rates for longer. Still on Nigeria, the central bank has confirmed that the next monetary policy meeting will hold on the 19th and 20th of February. We yesterday reported an earlier date in error. It still remains unclear whether there will be an update on inflation by the Statistics Bureau ahead of the meeting as rebasing progresses. Also, as the manufacturing sector groans under high costs of borrowing amid measured optimism on the long-term outlook. Many have asked me to comment on recent moves in the US pausing and reviewing laws banning bribery of foreign officials. I can't see why these laws need to be diluted, as this could result in more recklessness or embolden predators. But American corporations indeed have had to walk away from markets that China and even Europeans thrive easily in because the ethical laws make it too toxic and risky from a reputation and legal perspective. I also see that the market shapes not just prices but corporate behavior. We've seen of late companies receiving more lectures than usual from a government interested in decreeing cultural shifts, often interpreted as ideological, which is also why it was not surprising to observe the haste with which many of these programs are now being disbanded. Flexibility and adaptability for corporations are very key, but a strong corporate culture and strengthened shared core values that clearly advocate highest ethics and standards, equality, fairness, merit, and so on, should also have its place. Like I said yesterday, we should be prepared for many scenarios while bolder risk-taking and fewer rules will birth new entrepreneurial stars and arguably help economic growth. There will also be many Sam Bankman-Frieds and higher probability of Lehman Brothers situations. Perhaps there is need to be accommodative, greater tolerance and readiness to see more failures. There needs to be tougher lessons, definitely for the greedy, when the floor collapses, as it usually does when you bin the rules. Also, over time, it seems we get these swings from too much to too little regulation and then back as we juggle trade-offs. To our main story, which is on Powell's testimony, there are no bombshells to move markets. Congress has always expected too much from the Reserve Bank and also used the opportunity of cameras for political jostling. Powell was careful to express limitations of its role, mainly to deploying monetary policy tools at its disposal in response to contextual factors often beyond its control. Powell also radiated calm, which has to tell stakeholders that everything is in control, though he would not use the word soft landing, always resisting the temptation to take a victory lap that may someday prove premature. Powell was asked about his take on impact of recent developments affecting the financial institutional framework. In the US, we have seen more uncertainty as the Consumer and Financial Protection Bureau, CFPB, came in the crosshairs of the Department of Government Efficiency. Two senior officials at the Consumer Financial Protection Bureau exited as acting director. Russell Velt instructed all staff to cease working. Powell was questioned on the damage caused if CFPB was shut down, and he replied wisely that if indeed the gap as a result of closure of the bureau was not addressed, there was a problem, even as Republicans tried to allay concerns, saying that there were indeed other functions able to attend to consumer matters that CFPB previously handled. But Powell did his best not to wade into the ongoing structural transitions, repeating that their role is to respond with tools available to them to a context which is often out of their sphere of influence. The executive and legislature also have their roles to play in achieving a better economy. Let's hear what he said.
The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. We are attentive to the risks on both sides of our mandate. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady now since the middle of last year, and at 4% in January remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-term goal. PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak, after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of the progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks on both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve our dual mandate goals that Congress has set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Asia Pacific markets mostly higher as investors brace for impact of reciprocal tariffs on regional economies. This was after Federal Reserve Chair Jerome Powell indicated a cautious stance on further interest rate cuts, also as investors await the latest US CPI data. Chinese tech stocks entered a bull market as investors piled into internet companies following DeepSeek's AI breakthrough. Well, that's all we can take on this episode of Global Business Insight. You can watch us on BusinessDay TV YouTube channel Monday to Friday, 11 a.m. West Africa time. Thanks for watching. This is Bode of Shosami. Bye-bye.